Name's Dale Sullivan, and this is my investments portfolio. Economic forecast. GDP. GDP is the total amount of monetary value of the finished goods and services produced in a specific country at a specific point in time. The GDP figures increased by 2.1% in the third and fourth periods in the USA, which shows positive economic growth and outlook for the future. Inflation. Inflation is the general rise in the price of a country's products and services, where one unit of the currency cannot buy the consumer as much of a certain product as it did in the past. Trends show that inflation in the US have been steady over the past 30 years with some spikes. However, healthy inflation is considered to be about 2%. Unemployment is the number of people who are actively looking for jobs that cannot find a job. A low unemployment rate usually means a country economy is in good hands. The unemployment rate is the number of people unemployed divided by the number of people in the country's workforce. Economic forecast continued. Fiscal policy is where the US government makes use of expenditure and taxation resources to control economic outcomes. Monetary policy is the process in which government draws up plans, announces them plans, and then implements the final plans of action to be undertaken by the central banks or the Fed, in case of the US, who controls the supply of money and the channels in which new money is supplied to the country. The current monetary policy of the United States has three main goals that Congress has instructed the Fed to follow. The Federal Reserve directs the country's monetary policy by managing short-term interest rates, influencing overall availability and cost of credit to the economy of transient loan fees, and impacting the general accessibility and cost of credit in the economy. Monetary policy has a direct effect on short-term interest rates and indirect effect on long-term interest rates, currency exchange rates, and equity prices. US fiscal policy is rather imbalanced. Whilst unemployment, interest rate levels, and GDP is in a healthy state, the US has experienced rapidly growing budget deficits. One would expect with more people being employed, consumers would be able to use their money on spending, whilst investors generate profits in the stock market, contributing to more revenue for Treasury. However, the reverse effect has happened, causing the US budget deficits to steadily rise year after year. Risk profile and market efficiency. My risk profile is 23 to 28, which means I have an average to moderate tolerance for risk. Based on these findings, I would need to have a balanced approach. I would look to invest into bonds with a lower risk, while also looking to invest money into some medium to high risk stocks. Another approach could be to invest in commodities that offer some risk but potential for return. With $100,000, I would want to increase my portfolio to $200,000. My overall timeline would be 3 years to complete this goal. My target annual return would have to be 25.99% to reach my overall goal of $200,000. Short and long-term forecast. I believe that the healthcare sector will be a savvy investment. Pharmaceutical companies, medical equipment, biotech companies, they are continually evolving and bringing about new technology and developing new drugs and vaccines that will allow the stock price to steadily increase over time. The healthcare system has been recently lagging due to Democrat ideas to allow for free healthcare. However, I feel with the COVID-19 pandemic sweeping the nation, the race is on to develop a vaccine and drug that will be able to limit the damage the virus causes. I therefore believe the healthcare sector will see significant gain in the next 5 years due to companies being able to develop a drug or vaccine that will be able to cure this virus. I also believe the technological sector will yield above average returns The technological sector which will be another sector that will increase. As we've seen over the years, they have grown year upon year. The share price has just increased over the past years, with many technological firms spiking. A poor performing industry, I believe, will be the consumer cyclical sector. The industry measures the performance of retail stores, auto part manufacturers, restaurants, lodging facilities, residential construction companies, and entertainment companies. I strongly believe that during this time, theaters and restaurants and hotels will suffer greatly due to individuals not leaving their home as much. The first stock that I believe will yield positive returns is Amazon. Even before the coronavirus pandemic, consumers were shifting their attention to online shopping. Amazon is already a global powerhouse with so many individuals cooped into their homes. Amazon Prime will become a real hit. It enables free shipping, and also movie and music streaming. Once consumers enroll in Prime, they also start to buy more from Amazon. Amazon's new Just Walkout technology, which offers the opportunity for investors to buy technology in store whilst not having to check out at the cashiers. Their technology is being used in Amazon Go stores and being licensed to other retailers. Amazon stock has slightly decreased due to the pandemic. However, post-pandemic stock prices are expected to soar. The current valuation of the company stands at $926 billion, which has been ever rising throughout the last 5 years. I expect the current valuation to be stable throughout 2020 because of the catalyst that is the coronavirus. The average 1-year price target lays at $2,534, with a high of $2,900 and a low of $1,987. The second company I would invest in would be Abbott Labs. They developed the first diagnostic COVID-19 test, and 11 days later, they developed the fastest diagnostic test yet that runs on ID Now platform. They are constantly advancing their knowledge whilst being at the forefront of fighting this pandemic. Abbott Labs has numerous other products that will draw in investors. They have achieved tremendous success recently with their forward-thinking and innovative products, such as the glucose monitoring systems. Analysts on Wall Street believe that there will be constant development of new and innovative products. Abbott Labs can see a 10% earnings growth over the next 5 years. The 1.5% dividend yield is savvy for investors, and Abbott has increased their dividends for a record 48 years now. The 1-year price target stands at 103.5, with a high of 113 and low of $79. The catalyst for Abbott has been the outbreak of the coronavirus, which has put them at the forefront to fight and combat and defeat this pandemic. If Abbott can continue their magnificent efforts across the board, then I certainly see potential for company growth and investor making money off buying the company's shares. The two bonds I will be investing into will be BioStar Industries and American Express bond. The BioStar bond has a fixed coupon rate, a 1.92 cash to debt ratio, a Baa2 rating. The interest rates have dropped, therefore the value of the bond would have increased due to the reverse effect that interest rates have on bonds, especially with repo rates at the moment dropping due to the coronavirus. The bond's value would have increased. The second bond, American Express, is a fixed coupon with a 0.37 cash to debt ratio. Therefore, they have not financed a lot of their funding with debt, and it's currently unrated. This will be a good bond to invest in because American Express is a massive company and they have enough assets to finance their business activity. The funds that I will be investing into is Axis Blue Chip Fund Direct Plan. Has an 8.69 annualized return over 3 years. It is moderate to high risk, which suits my risk profile. The asset allocation of 78% equity and 22% debt, and it has a NAV range of 12.5 to 9.8 over the past 12 months. The second fund would be the Vanguard 500 Index. It tracks the S&P 500 and holds large stocks like Apple, Facebook, Amazon, etc. It is a long-term fund, and the 10-year growth chart of $10,000 is listed on the side, with it growing to approximately $26,700. Portfolio management. Passive and active management. Obviously, I'll be following active management of my portfolio. I will be doing analytical research, example, following market trends on a daily basis. Due to the coronavirus, the market is very volatile, so I have to make decisive decisions. Buying and sell stocks in response to changing market conditions. So therefore, I think a stock is a must buy. By looking at the various financial ratios, then I'll do so, and vice versa for sell. COVID-19 had a big impact on the market, therefore frequent management and decisive decisions need to be made on a daily basis. And then it is obviously a higher risk to passive management, which I will be passively managing my two funds, such as the Vanguard fund. Thank you very much for listening to my portfolio. I hope you all have a great day.